We detected an unusual trade worth $10 million on Alphabet Google stock, ticker symbol GOOG. And so in this video, we will analyze this unusual option activity to find out if this wealthy investor is bullish and buying or bearish and selling. Because as we all know, the rich have more access to exclusive research and information, sometimes even leaked insider information, to make better, smarter financial decisions. This is how smart money always seems to be one step ahead before the rest of the market catches on. And so without further ado, let's dive into our analysis so that our subscribers and members can profit from this deep knowledge too. As we can see here on the options time and sales tape, on June 10th at 10:02 at the 52-second mark, these December 19 options at the 190 strike calls were being traded 2,500 contracts 3 times. And we have a price of $14.10 for each of these call options. And so we can calculate the total cost of this trade. We have 2,500 contracts times 3 times. And we have a total of 7,500 contracts being traded. And we multiply by the price of $14.10. Keep in mind, this is option prices. And so we either move the decimal 2 places to the right or multiply by 100, since each option contract represents 100 shares of stock. And so each of these contracts costs $1,410. And so when we multiply this out, we get a total trade cost of $10.5 million. But keep in mind, just because a trade is large does not necessarily mean it has a high chance of success. In fact, the smaller, more selective trades that we share on our website have a higher chance of profit with a lower risk. And so, if you want to get access to the lower risk trades with a higher probability of profit, then go to our website. We'll put a link up here. Keep in mind that our members also get earlier access to trades like this before anyone else, before we share it with the public. So if you're tired of trailing the crowd and want more time to act on these opportunities, just head over to our website, where you can see in real time when and which stocks wealthy investors are trading on Wall Street, so that you can have the same opportunities as the rich. Because if the rich get richer, why shouldn't you? Now, with that said, we still traded this, but we use position sizing to manage our risk. As you can see here on the option chain for the December 19 options, at the 190 strike calls, we also got into the same position here. POS stands for our position, and the green color indicates a buy position. Now, how did we know these were new opening trades? Well, take a look here at the open interest. We have 11,000 open contracts now. And if we check the historical data, before this unusual option activity occurred on June 10th, we can see here for the June 9th trading day that for these December 19 options at the 190 strike calls, we only had 1,600 open contracts just the day before. And so the fact that the open contracts have now increased means that this wealthy investor opened new contracts at the 190 strike calls for the December 19 options, because it would not be possible to close out this many contracts if there were only 1,600 open contracts the day before. And so based on our analysis, this wealthy investor bought these 190 strike calls for $14.10, as we saw earlier on the options time and sales tape. And so when we analyze this trade, we can see here on the risk profile graph where the profit loss shows up here, and the x-axis represents the share price of the stock, which is currently trading over here, and the profit or loss is represented on the y-axis over here, and the zero break-even line is over here. And so when the purple line, which represents the current date, and the blue line, which represents the option's expiration date, are trading below the zero break-even line, as the share price goes down, this trade becomes more negative loss. And if it trades above the zero break-even line as the share price goes up, this trade becomes more positive, more profitable, because This is a long bullish trade, and we can confirm it on the option Greeks. We have a positive delta trade. If it was a short bearish trade, we would see a negative delta instead. But keep in mind the risk with this trade. We have a negative theta decay, which means that as time goes on, this trade loses value due to time decay. And that is why you can see here the purple line drops down lower to the blue line as we approach the option's expiration date. And that is why the break even on this trade, where it meets the zero break even line, moves higher as time goes on. And that is why, even though the call options that we bought have a strike price of $190, the stock needs to trade above $204 per share for this trade to be profitable at expiration. Because of this added risk, along with other factors, we only took a small position in this trade. We don't put a lot of capital into these higher risk trades. Instead, we focus most of our capital in the lower risk, higher probability of profit trades, the kind of trades we share on our website. We'll put a link to our website up here. Let us know in the comments. Do you think Google stock will move higher, or do you think it will drop down lower? As always, please like, subscribe, and until next time, let's keep tracking the trades of the rich so everyday investors can profit too. Take care and have a wonderful day.